On Business Incorporated today, S&P Global lowers South Africa debt outlook. Egypt's inflation hit 31.9% from 25.8% in January. And Kenya oil marketers head to court over credit facility for oil imports. Good afternoon. Welcome to Business Incorporated here on Channels Television. I'm John McCall. We'll start off as usual with market numbers, starting with Africa. And what we see in Africa is a whole lot of red, starting with Nigeria. Nigeria did lose that positive sentiment it closed with on Wednesday, down 0.22% intraday, but still holding on to that 55,000 at 55,678.14. GSE of South Africa remains in the negative, also 0.89%, and lost that 78,000 that it had on its all-share index, now 77,046.048. Egypt is the only positive at intraday, looking really good at almost 1%, 0.92%, at 16,466.17. While Kenya really needs some attention, as we see that it closed deeply negative yesterday, 3.63%. It used to be 128, now it's down from that to 123. I wonder what's happening in that market. I guess we'll have to interrogate that one of these days. We move over to the Middle East there. And over in the Middle East, it was, well, a mixture of it. Squarely mixed. Abu Dhabi is in the negative there, 0.81% at 9,863.72. Dubai also in the negative, 0.37%. But when we move over to same region, some other parts, Saudi Arabia, we see looks good at 0.62%, 10,474.87. Qatar, however, is in the red, 0.15%. All right, let's move now to Europe, where officials in the EU are continuing to express their anger at Germany as an ongoing spate over a block-wide ban on new sales of fossil fuel cars by 2035 ratchets up. We have Janelle now to fill us in on what's happening there. Hi, Janelle. Good afternoon. Well, first-hand information, obviously, since you were there in Berlin. Walk us through the EU's planned ban and what stage is it at this time?
So just as a bit of background, members of the European Parliament recently approved a new law to ban sales of fossil fuel cars by 2035. The aim of that, of course, was to support the EU's goal of becoming a climate-neutral economy by 2050, with net zero greenhouse gas emissions. And the rationale is that it gives automakers a plannable deadline to ramp up electric car production, and that it would also encourage investment and allow Europe to compete with China and the United States. Now, of course, as with most things within the EU, there was a camp for and against. Germany initially had worries that the change would be too abrupt and too drastic and would put hundreds of thousands of jobs at risk. But eventually it did agree. Suffice to say, this was actually meant to be a done deal, and EU lawmakers were meant to finally formalize and give it final approval this week. But then Germany went ahead and put the brakes on the process, causing more than a little displeasure within the bloc.
So I know you mentioned the worry of employment there, looking at it from Germany, but are there other reasons? Why did they agree at first and suddenly oppose this ban?
I alluded to it somewhat already, but car making is, of course, Germany's key industry. At least one German MEP has said that soaring electricity costs on top mean that electric cars would be more expensive for consumers. But a central part of this also has to do with German political wrangling on the national level, having an impact on bloc-wide policy making. So Germany's pro-business party, that's the Free Democrats, they've insisted on demanding a loophole in this EU legislation that would allow cars with combustion engines to be sold as long as they use so-called e-fuels or electricity-derived fuels. They're synthetic fuels produced using low-carbon energy that are supposedly climate neutral, but that's still in development. On top of that, environmental groups also oppose such fuels and say they're expensive and require huge amounts of electricity to produce. They also say that they're polluting since they emit nitrogen oxide, which is, in fact, another greenhouse gas. Now, back to the legislation. There's already a non-binding clause in the text that addresses the use of e-fuels, but the FTP, the Free Democrats, has feared that that is not going to be enough. Under the rules of Germany's governing coalition, however, and the FTP is one of the three parties in it, the other two are the Social Democrats and the Greens, they have to abstain from EU votes if they cannot agree among themselves. Now, what's happened is that since Germany has backed away, other countries who perhaps might have been more reticent about the law could form a blocking minority with Germany. You need 4 countries to do so in the EU, and it already looks like Italy, Poland, Bulgaria, and Czechia are getting into position. That is 5.
Mm. Yeah, because I was going to ask, what are the other members of the bloc saying? How are they reacting to this Germany's refusal to wave the plan through?
There have certainly been some grumpy reactions coming out from within the EU. It's obviously not a great look for Germany to change its mind after all the imaginably rather onerous legislative steps have already been followed. It's simply not done, and this is largely unprecedented. France has seemed especially annoyed. At least once, one French member of the European Parliament, Pascal Canfin, has warned that this move sets a poor precedent for Europe's decision-making process, in that other member states could feel emboldened to call into question other agreements forming the EU's push to achieve carbon neutrality by 2050. The French transport minister has warned that regulations like these have to be put in place. Otherwise, and this is a quote, we will be swept away ecologically and industrially. So anger really on 2 fronts. 1, that Germany appears to be going back on its word. And 2, some in the EU feel that the climate agenda is threatened by this challenge that might not remain confined to this issue. So this is, once again, a real test for the EU.
Yeah, certainly a real test, Janelle, and a real test to that unity of the bloc. But we'll see how it plays out in the coming days. Thank you so much, Janelle. Let's move over now to Asia, where shares were mixed on Thursday as China saw softening in its inflation print in February. The economy's consumer price index grew 1% year-on-year, the slowest pace since February 2022. The Shanghai Composite shed 0.22% to close at 3,226.09, and the Shenzhen Component lost 0.16% to end at 11,579.99. Hong Kong's Hang Seng Index dropped 0.22%. Japan's Nikkei 225 closed 0.63% higher at 28,623.15. Other topics climbed almost 1%, ending at 2,071.09. As Bank of Japan kicked off its 2-day monetary policy meeting. In South Korea, the Kospi slipped 0.53% to 2,419.09, while the Kosdaq lost 0.58% to end at 809.22. Australia's S&P AX 200 added 0.05% to 7,311.1. The United States stock futures were flat early Thursday as traders processed fresh job market data and comments from Federal Reserve Chair Jerome Powell. Dow Jones Industrial Average, we see, fell. Let's look at the numbers here. Dow Jones down slightly, though, 0.07%. And S&P 500 also down 0.26%. The technology companies come together at NASDAQ down. I think they lost more there, 0.58%. Let's go to oil now. Oil prices were near flat on Thursday as a larger than expected draw in U.S. crude stocks contended with worries that more aggressive U.S. interest rate rises would strain economic growth and therefore dent oil consumption. Brent crude futures had edged higher by 5% to $82.71 a barrel, while U.S. West Texas Intermediate crude futures gained 5 cents to $76.71 a barrel. U.S. crude stocks fell 1.7 million barrels last week according to government data, compared with what analysts estimated for a build of 395,000. Industry data late Tuesday showed a decline in crude inventories for the first time, about 10-week build. U.S. gasoline stocks drew down by 1.1 million barrels, according to official data, and that's less than the 1.8 million forecast, adding to demand concerns. Distillate inventory grew 138,000 barrels compared with expectations for a 1 million barrel drawdown. In the metals market, gold prices traded in a tight range on Thursday as some investors stayed on the sidelines ahead of U.S. jobs data that could influence Federal Reserve's monetary policy path. Spot gold was a little change at $1,813.39 per ounce, trading in a $5 range after hitting its lowest since the 28th of February. U.S. gold futures eased 0.1% to $1,816.70. Federal Chair Paul on Wednesday, that was yesterday, reaffirmed his message of higher and potentially faster interest rate hikes, but emphasized that debate was still underway with a decision hinging on data to be issued before the U.S. Central Bank's policy meeting, which is in 2 weeks. Following Powell's remarks, markets are now pricing in a 50 basis point hike at the Fed's March 21st to 22nd policy meeting. Let's come to Africa now. Standard Bank Group Limited, which is Africa's biggest lender by asset, says it has made provisions to cover more than half of its holdings of Ghanaian bonds as the country works to reorganize its debt. The Johannesburg-based lender set aside 1.5 billion rand, that's about $81 million, to cover potential losses arising from the West African nation's loan restructuring program. The bank said its total holdings of both domestic and onshore dollar-denominated bonds is about 2.6 billion rand. And S&P Global Ratings unexpectedly lowered its outlook on South Africa's junk-rated debt to stable from positive, dealing a blow to the country's efforts to regain an investment-grade rating. The company revised the outlook while affirming the nation's long-term foreign currency rating at BB-. That's 3 notches below investment grade, according to a statement on Thursday. Its first South African sovereign credit rating action of 2023 had been expected in May. In response to the challenges observed by S&P, the government of South Africa acknowledges that higher economic growth and a durable recovery in economic activity require a stable macroeconomic framework, complemented by rapid implementation of economic reforms and improved state capability. According to a statement issued by the National Treasury, government is taking urgent measures to reduce load shedding in the short term and transform the sector, that's the power sector, through market reforms to achieve long-term energy security. Other reforms are underway to improve performance in the transport sector, in particular freight and rail. We move to East Africa now. In Kenya, oil marketers have moved to court seeking to stop the planned importation of fuel on credit from the United Arab Emirates in a government-to-government deal that officials have said will ease pressure on dollar demand. The dealers, through their lawyer, say that the plan by the government to pick a local oil marketer breaches the open tender system where marketers competitively bid for the tender. The oil firms also allege that there was no public participation and stakeholder consultation before the gazettement of the Petroleum Importation Regulations of 2023, which is a breach of the Constitution. The imports, which will come through a credit of 6 months and a year, are expected to ease a crisis in the foreign exchange market, given that oil shipments account for 28% of Kenya's monthly imports. Under the deal, the local firm nominated by the ministry will import fuel, and other marketers were forced to buy from the local market and transit to neighboring countries. State officials have been guarded on how the shipments will affect fuel prices in Kenya amid concerns that the longer credit line could wipe out the benefits of buying diesel and petrol in large quantities. Pump prices have remained unchanged since November, with a litre of super petrol retailing at 177.30 shillings in Nairobi, and diesel goes for 162 for a litre, and that's up from 106.99 shillings and 96.40 respectively in February 2021. Now, Botswana is the second largest producer of diamonds, ladies' best friend in the world, and that's after Russia. Russia is the first, but here in Africa, Botswana is first. And is expecting that there'll be a drop in diamond jewelry demand this year, 2023. This is expected or estimated to lead to a 1% fall in diamond production and 7% decrease in trade. Imagine what that would do to employment and revenue in Botswana. But let's have Danielle now. Daniela Omubodede is an analyst with Financial Derivatives Company and joins us virtually from Victoria Island to help us expatiate on this. Hi, Daniela. Good afternoon. So why are we expecting this drop in diamond jewelry? What's happening? Ladies don't want to look good anymore?
Good afternoon. Thank you for having me. So as we all know, diamonds are the most precious and popular gemstone. And aside from being used to make jewelry, they are also used to make cotton and polishing tools, and are also even seen as a store of value. So because diamonds are a luxury item, their demand is inelastic. The major reason for this decline in the demand for diamond is as a result of slowdown in consumer demand in the United States, which is the top importer of diamonds in the world. This is as a result of the high inflation level, which has put a pressure on real income and purchasing power and the consumption patterns of diamond consumers.
So there's also the competition that comes from the lab-grown diamonds. Any chance that will replace the real diamonds, at least because of prices?
Lab-grown diamonds are not fake diamonds. They are normal diamonds. It's just that they are produced differently in the lab using crystallization. So when compared to the natural diamonds, which have been formed over 800 billion years in the Earth's crust, lab-grown diamonds can be made in a lab in a few weeks. But then they are most likely not going to fully replace natural diamonds anytime soon. Although they are more affordable and there is no controversy as to surrounding their production or how they are sourced, they are still synthetic. And at the end of the day, people are always still going to prefer authentic items over synthetic items. But then let's not forget that natural diamonds are limited in supply. So there might be a time that they might not be able to meet demand. But until then, lab-grown diamonds are not going to fully replace natural diamonds.
All right, Daniela. And then there's been the talk of, the blood diamonds and efforts to curb that and reduce it, especially in countries that are diamond rich. How successful has that been, and how is it affecting the economy of those countries?
Yes, so first of all, blood diamonds are diamonds that have been mined in war or conflicted areas such as Angola, Sierra Leone, or Liberia. These are diamonds that have been used to finance terrorism or insurgency. So in 2003, there was the introduction of the Kimberley process, which is basically like a certification or like a passport for the diamond showing the authenticity of the diamonds, how they were produced or where they were sourced from. So before the introduction of the Kimberley process, about 25% of illegal diamonds were traded in the market. But afterwards, we've seen that amount slow down to between 5 to 10%. However, there are still some loopholes in the process. So for example, in Central African Republic, there was a ban on the exportation of their diamonds as they were once used to fund a genocidal war. But then we have a situation whereby these car diamonds are being smuggled to Congo, and then they are issued the Kimberley certification, Kimberley license, and then they are being traded internationally. So as you can see, there's still some, like they have not been able to fully guarantee the integrity of the diamond supply chain. So for these conflicted diamond-rich countries, they are being faced with a resource cost syndrome. So at this point, the presence of diamond is seen somewhat as a cost for them and not even a blessing, because people wouldn't want to purchase this blood diamonds from them.
All right, Daniela, thank you so much for giving us some insight on that, on diamond. Daniela Omubdo, Dede is analyst with Financial Derivatives Company. Enjoy the rest of your day. All right, let's move over to Egypt now. It's not good news from there, as we see inflation rate climbed to 31.9% in February from 25.8% in January, a higher than expected increase. The figure reported by the State Statistics Agency, CAPNAS, is the highest in more than 5 years, and it's driven by elevated food prices, which soared 14% month on month, and also by a 62% annually. The sharp rise in food prices is a reflection of supply shortages as well as speculative activities by traders rather than being purely an impact of a weakening Egyptian pound. One of the largest food items to see major price hike is poultry, where shortage of feed as well as speculation about its prices in light of foreign exchange uncertainty disrupted supply and increased the cost of the end product significantly. The sharp increase in inflation follows the slide of the Egyptian pound by about 50% since March last year and coincides with the persistent shortage of foreign currency that led to long delays in getting imports into the country, something that has in turn hit industries badly. Moody's cuts Egypt's credit rating due to reduced buffers and shock absorption capacity. Still in Egypt now, the country has almost come full circle in winning back and then losing confidence of bond investors just over 2 months after sealing a deal with the International Monetary Fund. The next pivot point for Egyptian bonds will center around asset sales, and any delay there is set to deepen the crisis and cast doubt on the country's money market. Earlier in the week, the Financial Regulatory Authority, FRA, decided to allow the listing of bonds and sukuk with credit ratings. As per the FRA's resolution, the value of bond or sukuk issuance shall not exceed that of the company's asset value, with only eligible investors having the right to trade on the bonds or sukuk through a private offering. This decision aims at cutting the costs of listing and issuing bonds and sukuk to facilitate the process for companies to receive necessary funds for expansion and future investment plans. And the Executive Board of the International Monetary Fund has approved immediate disbursement of $114.8 million to governments of South Sudan to help it address the urgent balance of payment needs arising from the food insecurity. And then in Zimbabwe, the tobacco farmers owed by merchants for the crop delivered last season will receive their balances by the end of this week, with the Tobacco Industry and Marketing Board vowing to ensure a similar situation does not occur this year. Failure to pay the farmers on time, TIBM chairman said that tobacco merchants risk heavy penalties, suspension, or cancellation of their licenses. Last year, TIBM blacklisted some tobacco merchants after they failed to pay the farmers for deliveries made. In terms of the law, payment should be made within 48 hours after the sale. Zimbabwe's 2023 tobacco marketing season officially opened on Wednesday, with the yield expected to rise to 230 million kilograms for this year. Last year, the country produced 212 million kilograms of tobacco, with 98% of the crop exported. Well, that's the program for today. Thank you so much for being a part of it. We do have a final one for you tomorrow, Friday, so do join me then. Enjoy the rest of your day. I'm Ini John Mekwa.